So here's the deal. Years ago, I read the book A Random Walk Down Wall Street, and it lays out using data as proof that buying and holding a broad-based, diversified portfolio of index funds is really one of the best ways to maximize your returns. Why? Because you are getting out of your own way. And by that, I mean you don't have to make many decisions. The only decisions that you have to make are asset allocation, but even before that, to simply just automate your investing, to buy and hold index funds for the long run. Because what matters most is not timing the market, as my friend tried to do in March, but rather time in the market. And the data supports that. So if you're looking for some good information about this, there's plenty of articles on YouTube and on the internet to show you this. And I want to show you some key statistics. But if you really want to get like down and dirty and really kind of dive into why this is, take a look at the book A Random Walk Down Wall Street by Burton Maciel. A great read for anyone who's serious about investing. But just a quick internet search turned up all kinds of charts and data that I think are proving the point and are totally enlightening about why we should not worry about dips. Now, granted, have we had lost decades in the past? Yeah, we've had periods in the stock market where it's just gone horizontal. We've had periods where it's gone down and it takes 8-10 years to get back to even. But here's the deal. There's two thoughts. One is that if you dollar cost average, meaning that you invest at regular intervals, you're buying on the way down, and your dollar buys more shares on the way down and at its lowest. And so you're averaging your cost of ownership and your entry point, essentially, of those stocks that you hold at lower and lower numbers. And so even though it may cost or take, 5 years to get back to normal, 10 years to get back to normal meaning the original peak. If you dollar cost average, what happens is that it doesn't take as long of time because you're buying more shares on the way down, and so you're going to be breaking even sooner. So even if you have a lost decade, and the market moves horizontally, or you enter into a dip, it's still important to invest. The second important point is that if you try to time the market, that is sell high and buy low, if you try to time the market, you have to be right twice, and that is very difficult to do. Not only do you have to be right on when to exit your positions and sell at the peak, you also have to try to be right knowing when the bottom is. And that, as we saw with this recent escapade, is very, very difficult to do. So we saw basically a flash crash happen in December of 2019. Just out of nowhere, the market went down. Maybe it was December 2018. But the market just severely went down. It was like 18% in a single month. It looked like all of the gains for the year were just given up. But by mid-January, just a few weeks later, we were back to normal. And so good luck trying to sell at the peak, buy in the trough, and then turn around and ride it back up. It didn't make sense. It happened too quick. It's very, very difficult to do. And the same is true as we see happening right now in this recent trading episode. Mid-March, stocks were really bottoming out. But since then, they've come back. And so if you held your positions, you would be okay. But if you panicked, now good luck. You sold at the bottom, and now you're buying at even higher levels. Or do you sit and wait and hope that it goes back down again? Look, if I had a crystal ball of investing, I would be a multi-billionaire. But I don't. And neither does any pundit on CNBC, or neither does any personality, neither does anyone who's sitting on talk shows and stuff like that. The best way to do it is slow and steady wins the race. Just consistently invest with every single paycheck, and I promise you, in the long run, you will be a very happy camper, because the market has returned almost 9% a year since its inception. You don't want to try to time the market. What matters is time in the market, and the data supports that. So let's take a look. So just recently, we see in the most updated article that I found very easily why mistiming the market can be disastrous. This was on April 20th. So I want to show you a chart real quick. Take a look. This is $10,000 invested for 38 years, from January 1st, 1980 until 2018. And if you were to invested $10,000 just once, just drop it in, walk away, come back to it 38 years later. Think about what we rationalized $10,000 on. Maybe we're buying a car, but that next level of car has leather seats that are cooled and massage us. Or maybe it has a little bit nicer of a CD player, or an audio system. Or it comes with chrome wheels, right? Think of all the different ways that we easily get tricked into spending $10,000. And how do they do it? Because they break it up over 8 years of payments, right? So you don't think of it as 10 grand. What do you think of it as? Oh, it's another 80 bucks a month. Yeah, I can afford that. Focus on the whole picture. But if we take that $10,000, we drop it into the stock market. January 1st, we buy an S&P 500. We walk away for 38 years. That 10 grand, through all the ups and downs, through 1987, right, when it crashed in October, through the dot-com bubble of 2000 to 2002, if you were to keep that invested, and by the way, we are beyond where we were in 2018. So even if we extended this data to today, this would still hold true. You would have $708,000. $10,000 would grow to $708,000. That is incredible. That is the opportunity cost of the money in your pocket today. Rule number 4, you want your money to work for you, not you for your money. But if you miss the 5 best days, now think about that. The 5 best trading days. There are 280 trading days per year over a 38-year period. My goodness, let's see what that is. 280 times 38. That's 10,640 trading days. If you miss 5 of the best 5, good luck trying to tell me out of 10,000 days which are going to be the 5 best. If you miss that, your $708,000 shrinks down to $458,000. That is a decline of 35%. 35% of your total return is gone if you miss out on just the 5 best trading days over a 38-year period. That is insane. 35%. I'm at a loss of words. And it gets worse and worse from there. So if you miss the 10 best days, now you're down to $341,000, a 50% reduction. This alone is enough to convince me, and hopefully you, that you should simply buy and hold a broad-based portfolio of index funds. And in doing so, ride the roller coaster. When you know the market is down, when you think the sky is falling, literally just don't even log in. Don't look at your account. What I personally do is when the market has a really bad day or several days in a row, I focus on the things that I'm grateful for. I focus on the things that I have and the things that I can control. I say thank you that I can be a teacher. Thank you that I have a wonderful wife. Thank you for a loving family. Whatever the case may be, focus on the good. And don't worry about the numbers in your portfolio, because statistics show that they will come back. And it's not only just this. I mean, we can take a look at even more here. Looking back at data dating back from 1930, The Bank of America said that if you missed the 10 best days in each decade, 10 best days in each decade, your total returns from the 1930s to today would be just 91%. If you bought and held, walked away, went out and lived your best life, then your total return, never sold anything, would be almost 15,000%. You went from 91% to 15,000%. Why? Because you weren't trying to time the market. Instead, you were focusing on the time in the market. That is why this whole thing is about using money as a tool to go live your best life. The system works. You just have to understand the way it works and to buy into it and not try to change the way the system creates immense amounts of wealth. January 4th, 1999, near the peak of the dot-com bubble, right? The bubble is about to burst. Till December 31st, 2018. What are we looking at here? We're looking at, 18 solid years. So, fully invested S&P 500, you would have had an annual return of 5.6%. But if you missed just 10 days in 18 years, your annualized performance drops to 2%. Guys, if you're missing out on 3.5%, or as we saw in the other statistic, 35%, it's going to be very, very difficult to become wealthy. Look, no one enjoys losing money. Warren Buffett even says, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. One of the ways that you don't lose money is by not selling emotionally, by not selling when you're in a panic. And the studies and statistics prove that. I'll show you one more just to really reinforce it. Take a look. So this was a great article called Time, Not Timing is What Matters. And take two different people. The one person who is the best day investor. They bought at the market lows over a period of time versus the worst day investor. This is the person who bought at every market high. They both start off in 1999 with $10,000. And the person who's the best investor comes ahead with 9.16 return by 2018. And the worst possible investor, the person who always bought at the market peaks, comes out with almost 7% annual return. The difference is 546,000 versus 415,000. They're both coming out positive. So think about it. You don't have to try to time the market, okay? But what's most important, even if you are the worst investor and you are buying at the peak, you're still coming out positive. Why? Because your money is still in the market. A lot of people will ask me, they'll say, is now a good time to invest? Especially when they're starting off young. They're 18, 20, 22 years old. And they're saying, oh man, I don't know, the economic conditions, I don't know if this is a good time to enter. And I say, okay, I get it. It's your first Roth IRA, first time getting your feet wet. How much are you putting in? And they say, oh, I got $5,000 to invest. I said, okay, and you've done all the reading? You know that compound interest is going to work. You know that you're going to be, making it automatic and you're going to be doing this for the next 40, 50 years. And they say, yep. I really think I can end up with a couple $1,000,000. I say, okay. So let's say, what's the difference, $5,000 if you're going to end up with a couple million? What does it really matter if you lose 10% on that $5,000? $500 compared to the 5 million? It's about the habit of consistently investing at regular intervals. That's what this is about. That is one of the keys to wealth. Discipline, guys. Emotional and financial discipline. Focus on controlling your emotions so that your money can go out there and work. Your money is a reflection of what's going on inside of you. It's a reflection of your values. It's a reflection of the respect that you give it, even the respect that you give yourself. Let money do what it does best when you are the master, and that is grow. Do me a favor, hit like, subscribe, notifications on this channel. Stick with me as we try to teach you the slow and simple way to become wealthy that frees you up from financial anxiety so you can go out there and focus on what really matters in life, which is relationships, memories, living with purpose, and go out there and go live your best life. Till next time, guys, take care.